What's up, guys? All right, so this next panel, we're talking about investor perspectives, funding in commerce, retail, and consumer. And we're talking a little bit, I want to start with this growth versus profitability question, although as we were kind of getting into it, there's some pretty obvious answers to this. But why don't we start with some introductions? Rachel?
Hello, everyone. Thanks for sticking around. My name is Rachael Ulman. I'm a venture partner at an early stage VC firm called Elizabeth Street Ventures. We invest in consumer fintech, and commerce enablement. We're an early stage investor, so typically seed and Series A. Sometimes we're the first capital that would be that an entrepreneur would take from outside. And to give you a sense of some of the companies that we're invested in, on the fintech side, we have a digital bank called Current. We also have a sports betting app called Better, which, if any of you know anything about the infamous YouTube star or professional boxer Jake Paul, he's a co-founder. On the consumer side, we have a hot sauce company called Yellowbird. We also have an experiential concept called Museum of Ice Cream. So if any of you are ice cream fans or sprinkle pool fans, just to give you kind of a flavor of the types of investments we're invested in.
Love it. Anton?
Hey, everybody. My name is Anton Romash. I'm a partner at Provenance. We are a consumer growth equity firm, kind of investing across all categories of branded goods and services, but really targeting kind of the more growth stage. So I'd say a tick after Rachael and the team at Elizabeth Street. We actually have a portfolio company in common that they referred to us when the time was right. Yeah, our check size ranges typically somewhere between 10 and 50 million, and we have a very data-driven strategy to help teams figure out the most capital-efficient omnichannel growth path forward. Some of the examples of brands in our portfolio, just to give you guys a sense of what we do, would be things like Marine Layer in lifestyle apparel, Makeup by Mario in the beauty category. We have a home brand called Fireclay Tile, which is, I think, the only vertically integrated D2C tile company out there. We also have a business called Everyday Dose, which makes a functional coffee. So truly kind of across all categories of consumer.
Very cool. Yeah, I love the perspective we're going to get here because you both have very different focuses in many ways. Rachael, I'd love to kick off with you. By the way, Yellowbird's delicious. Okay. I think one of the questions that we kind of bumped into is, there's different ways to view this growth versus profitability question, especially early on. So how have you been looking at this early perspective? And is growth more important or is profitability more important?
Yeah, and so this is a common question. And I think, like I said, we invest really early. So oftentimes we're pre-revenue even. Yeah. And in those early days, we're really looking for some signals and some proof that there's product market fit. So that the product you are able to find customers that love it, that are referring their friends, that are coming back and repeating. So in those early stages, growth is a huge priority, and being able to show momentum and trajectory in revenue. More so than being profitable and having a bottom line positive. Yeah. In fact, most times, if you can be profitable for day one, you don't need VC funds. Right. And it's usually where you want to go faster or you want to invest in new technology or in marketing that you need some additional capital to kind of fuel that. So
this is kind of a duh question, actually.
Well, no, it's just, I think for early stage, growth is, I think, paramount. Yeah. Yeah. But I think it does kind of change as...
Yes. So you, in the pass off here, when you come in for the next round, what are you looking at?
Yeah, I think I completely agree with everything that Rachael just said. It's probably premature to focus entirely on profitability from the get-go. And, so I'd say in the early stages, we want to see lots of growth. Otherwise our brand's never going to get to us anyway. So long as it's capital efficient growth. Right, so I think the reason we're having this discussion and why you sort of think it's a silly question, because hopefully people have learned this lesson by now, but there was a period of time where there was a lot of free money available and folks were raising big rounds and burning it very quickly and raising successive rounds. And you look at some of these businesses and they generate a lot of top line, but they're not doing it sustainably. Where you start to look at things like unit economics and product margin or contribution margin, and you realize that even at scale, this is just not going to be a capital efficient, profitable business. Yeah. And so there was a lot of that going on where nobody asked that question for too long. We tend to think of sort of growth and profitability as opposed to growth versus profitability. But really, they're kind of two sides of the same coin. And we like to see brands that are kind of taking what the defense is giving them. So there will be times when you have an opportunity to step on the gas very efficiently. And so, that might take you a couple of steps back on the bottom line, on EBITDA, however you want to think about it, on contribution, after marketing, whatever the metrics you're tracking are. But if you can sort of say that, hey, we're highly confident in our cohort quality, and what this looks like a couple of years from now is, we're acquiring a boatload of customers very efficiently. It's going to turn actually into a lot of profitability down the road, maybe in a year, maybe 2, maybe 3. And so long as you're not, burning through too much and being inefficient with it, you can kind of play with that trade-off between growth and profitability in real time.
So this is a zig and a zag process. You're kind of playing the Bill Belichick style of investing here, like how you think about these businesses. Take what the defense gives them.
Yep.
That actually, though, doesn't that kind of depend on the founder and like how opportunistic they are? Is that a big measure in when you look at these founders?
Yeah, I think that's definitely part of the equation, and a lot of that comes down to where the founder has experience, right? If a founder comes out of a marketing background or digital marketing background specifically, they may be super confident building their business through D2C e-commerce. But if it makes sense for them to think about catalog or owned retail at some point, they may not be as confident in those channels, right? And so that's when they kind of typically look to bring in somebody that can help them figure that stuff out. Interesting.
Yeah, that makes sense. Another thing I kind of picked up on there is you talked about free money just being thrown around, no thought of CAC, no thought of how are unit economics. Did that actually happen? That era of free money actually happened? And I'm going to ask this real quick because there's a lot of dry powder out there right now.
Yeah.
And when that dry powder starts to hit, is it going to get spent the exact same way that it got spent before? I'm sorry, this is a really I'm putting you on the spot right now, but Rachel, what do you think?
Yeah. So it's definitely changed in the past couple of years. 5 years ago, there was a lot more free capital that was kind of in the market, and I would say that founders were able to raise more quickly. Now it's a little bit of a tighter environment, so I think the uniqueness or the value proposition that investors are looking for needs to be a little bit more solid than it was.
Okay.
Having said that, I think the same fundamentals that we were looking for before, we're still looking for.
Right.
And I think that the era that we're in now, it's more important than ever for founders to really be mindful of their cash position.
Yeah.
The runway, how much time they have left before they absolutely need to raise, and just start a lot earlier in that process, and really focus on making sure that the metrics are so compelling that it's a very easy investment case for a VC fund to make.
That's interesting, yeah, because I think what I heard you say was, Anton, that, and both of you actually, growth is actually the number one thing you're looking at, because why would anyone be getting money anyway? You're saying you're going to still look for the same things you used to look for when you were making investments. There's money to spend, but there is a little bit more caution. And I think actually in this space, and we've seen a big swoop of money come in maybe 4 or 5 years ago in the D2C gold rush. But the market's a lot more crowded. The modern brand is a lot easier to make than it was before, and it's easier to copy things. How are you thinking about putting money into crowded positions? Because I think it's not just about CAC. Anton, I'll go to you first.
Yeah, sure. I think it's an excellent point. One of my partners likes to say that the barriers to entry have never been lower, but the barriers to excellence have never been higher. And I think we see that in every category of consumer. Particularly now with sort of the advent of all these AI tools, it really has never been easier, right? You can be so much more efficient. You need, a fraction of the team size that you used to in order to, produce ad creative. There's a whole host of 3PLs that'll work with you. There's a whole host of, factory partners that'll, create wonderful product. And so I think it's kind of led to a lot of proliferation of brands that all kind of look and sound alike. And so, there's multiple ways to kind of try to parse through that. But one of the ways that we try to do that is to really focus in depth on who the customer is. And we look at every single transaction from every single customer since the beginning of a brand's life to try to identify who is the super loyal kind of core consumer tribe, as we refer to it, that is over-indexing and engaging with this brand in more ways than anybody else. That's really what we look for is, a brand that resonates with a specific slice of consumer in a highly authentic way.
Isn't TAM too small then?
We literally say it's tribe, not TAM, because pick any category. In apparel, the TAM is like $300 billion or something like that, right?
Yeah.
Or maybe 400 now. Does that really matter? Like this isn't, I think some of that irresponsible behavior that came with the free money, a lot of it also kind of came from that mentality of that consumer behaves similar to technology and SaaS and software where there's these massive TAMs and all you got to do is grab, a 0.5% or 1%. The consumer doesn't work that way, right? And I think people have now kind of realized that, which is why I think, you'll probably see talking kind of about the dry powder and sort of this, growing mountain of it. Don't quote me on this, but I recently saw some metrics that basically point to the fact that 25% of that dry powder sits with the top 25 firms, right? Out of hundreds and hundreds. So I think most of that dry powder kind of accrues to later stage private equity and definitely, not so much to the early stage investment community. I just think, that combined with the fact that a lot of technology investors crossed over into consumer with varying success and have since kind of pulled out. I think what's now left at the early stage are consumer specialists. And it's not a very long list of people.
Well, and Rachael, that's actually you. You cross over both. So what do you think about that?
Yeah, and we do a lot, so consumers are core. And anything that we do is ancillary to that. So even in fintech, it's got to have a really strong consumer element. So it's not a B2B fintech company. It's a sports betting app that is directly targeting consumers. So that's always about what is the customer you're trying to go after, and how can you become and convert them into a rabid fan for your brand. So I think that's still the same. What we look for, again, is, are you in one of the categories we invest in? Do you have a differentiated, defensible position? Like what makes you special? Is it because you have a competitive advantage in marketing? Like is the founder a former marketer that's really skilled? Do you have proprietary IP? Do you have a license for, some sort of material science that no one else has?
Yeah.
So, do you own the supply chain? So we really look for like those unique characteristics and that are going to resonate with the customers.
I think that's super interesting because actually a good example of a brand that did really well in what we can call the ZERP era, that stood out really well. They spent a lot of money, and I'm going to speak maybe a little bit too harshly here, but like Outdoor Voices had so much momentum coming out of ZERP, and Tahani was a compelling founder who knew how to spend money. And she knew how to build something that felt differentiated. But everyone's now, looking back now, everyone's like, that CAC was out of control. Like, that was irresponsible in terms of building an experience that people absolutely loved.
Yeah.
But guess what happened when they tried to optimize that? and like turn it into something that like you could actually make money on, kind of killed the brand. And I'm speaking harshly. I don't like Outdoor Voice is not dead, but like it kind of did. So how do you balance like differentiating? And I think you actually already hit on it a little bit, like having some sort of proprietary like technology, whether it be fabric or it's whatever your category is. How can you balance standing out like crazy and then being able to turn that into like profitability?
Yeah, you know, we are co-invested in an athleisure brand. So we, know the space. It's called 10,000.
Oh yeah, it's cool.
Yeah, it's primarily a menswear athleisure brand. But I think that it's about creating a compelling story around a customer value proposition and really identifying who that target customer is, and then marketing to them in a way that really resonates. So this is for kind of the true athlete that's like lifting and really rugged, and it's not kind of the yoga athleisure go to necessarily like the coffee shop, although you can absolutely wear all the clothes. But so I think that there's no secret formula for how you do marketing to convey that message, but I think using a lot of the tools that are available today, it makes it a lot easier in some ways, but also creating a really cohesive brand voice that's going to resonate with that customer segment is more important than ever.
Yeah.
I don't know if you'd add anything.
Yeah, I think you mentioned product market fit kind of earlier in the conversation. I think that's where a lot of these brands are falling down today. It's a very different concept, right, than it is in technology, right? It's sort of this constantly evolving thing, but you have to kind of keep an eye on how is your brand positioned to the customers relative to the competition. Are you actually providing something unique and differentiated? It doesn't have to be entirely unique. At the end of the day, a good fabric is a good fabric, and fabric mills work with lots of brands, and so it's almost impossible to have a moat, for over the long term on product, but you can still be innovative, right? Through construction, through fit. Are you finding that slice of consumer and solving a need for them that nobody else is, and are you then pricing that value proposition appropriately, while considering your own margin profile, while considering the cost of customer acquisition and how that's going to evolve as you turn on new channels, right? So
this sounds complicated.
Omnichannel is incredibly complicated, and it's only getting more complicated.
Yes, I agree. Why would anyone become a founder right now? There's so much to think about. It's so many skill sets you need to do this. Rachael, when you're investing pre-revenue, who are these people?
I think you have to be like a little bit out of your mind to do it, because that's where the passion comes from. That's where the tenacity and the grit, and I think that every founder that believes that they can start something from scratch and build it into a huge successful business has to be a little out of their mind. But that's exactly what makes it magic.
That makes it good. Okay. We only got a couple minutes left here, and I wanted to ask you, so this is all leading up to this, what are the markers that you're looking for in the next 18 to 24 months for the money you're going to spend? Like, what kinds of businesses are you looking for? Or maybe some key markers, and we can't get into all of it.
Yeah, I think the quality and sustainability of the growth, making sure that that growth is actually coming from the team pulling on a lever rather than a company just riding a wave of a trend. A few years ago, there were folks that say, we only want companies with organic growth. That's a really scary concept to me, because if you don't understand what's driving that organic growth, if you can point me to an organic social strategy that's driving that, that's great, right? That's not going to come for free either, right? So that's just a different type of performance. But yeah, we look for truly sustainable growth, for a path to product and category expansion, because a lot of every great brand starts with a hero product. But every great brand also has to evolve beyond that hero product in order to become a brand, right? Otherwise, you're just a product business. And so seeing that potential and seeing the potential for multiple channels, multiple marketing channels, multiple distribution channels. We I think all learned a long time ago that these trees don't grow to the sky. And I think the only way you're going to get to the full potential of a brand in what is becoming an increasingly fragmented market is by tapping all of the channels available to you.
Amazing. Rachel?
Yeah, I echo exactly what Anton said. And then, as far as the types of categories, we're following some trends around, health and wellness, obviously, sustainability still. And then we've always been focused on a digital consumer and just kind of the changing buying patterns that, both consumers learn about products, but also experience products, and creating a true kind of digital, online, offline experience to make the brand come more alive. So, that's always been what we've found really compelling is, how do you continue to ride that wave of consumer adoption of, true digital kind of first mentalities.
Love that. Well, thank you so much both for your insight into the space. My takeaway is, if you're a founder right now, you need to be a crazy person. Thank you all so much.
Thank you.
Thanks. Thank you, guys.